explanation about what you actually see in the market, some reactions in the market, some movements in the market, the way we call them. Okay. So we always like the market, as I said, the market is always either moving to the upside or is ranging or is moving to the downside. You remember when we actually explained about market structure. Okay.
Yeah.
So that's what we can actually say it's like price cycle, because it is how the market is moving. So it's just like price cycle, we are just labeling those movements in the market. Like if the market is moving to the upside and it is in a bullish market structure, how do we call it? And if it is maybe slowing, like moving down and again moving to the upside, so there are those, like we call them price cycle. Just like the market is always doing something in a repetition. Okay, we don't have anything new. Like every movement is just like it can just be the opposite of what happened before. Okay.
Okay.
And so for example, we always have what we call accumulation. Okay, or what we call consolidation. Okay. The market always forming this kind of thing. Like there is always some time when the market is accumulating, or what we call consolidation. Okay, so sometimes the market may actually create consolidation, which is what we call accumulation, and also sometimes the market may break out of that consolidation. Okay, so if the market breaks out of that consolidation, we call it expansion. It can be to the upside or to the downside. Okay, so if we had a consolidation and price breaks out of this consolidation to the upside, so we call that expansion. Okay, so this movement is what we call expansion. Okay.
Okay.
So this is an expansion. Or the market may actually break to the downside. So also this one is expansion. Okay. So expansion is that break of structure outside of the consolidation. That's what we call expansion. Okay. Price is expanding to the upside or is expanding to the downside. Okay.
Clear.
And after that, we always have what we call pullback. Okay. The market may always tend to create a pullback. It can be a pullback to the order block, or it can just be a pullback which is not going to actually reach where we have our order block. It may just be what we call a weak pullback. Okay, so you see price moving to the upside, creating this expansion, and pullback is when price revisit this area. Okay, pullback, which is what we call retracement. Okay, so we call this retracement. So when price is actually what you can call moving down, trying to fill either an imbalance here or trying to actually mitigate what you call an order block, we call this retracement.
Okay.
Price is actually pulling down, again trying to actually fill any imbalance or trying to mitigate an order block. And the moment maybe price has reached where we have our order block somewhere there, the moment price start to move to the upside, this is what we call reversal. Okay.
Okay.
So it works in both ways. Okay. So an example is here, we see the structure. So we have this expansion, this consolidation here, which is accumulation. We have this expansion outside of the consolidation area, and then we have this retracement, trying to fill an imbalance and mitigate our order block here. Okay.
Clear.
After that has occurred, price has actually filled an imbalance and mitigated the order block. Then we expect to see if we see this kind of movement to the upside, this is what we call reversal. Okay. So in the market, we are always predicting a reversal. We are always trying to predict if the market is going to form a reversal to the upside or to the downside. Okay.
Okay.
Yeah. So we always see this in the market before so the only thing that we are always not able to see at that time when we're actually trying to trade is the reversal. That's why we always like, you buy here expecting to see a reversal. Okay. So if it goes your way, then you are actually in good profits, and if it goes against you, it means the market is actually against your direction. Okay.
Clear.
So an expansion is the movement. So you can see an expansion and there's order block here. Okay. So this means expansion is where we actually need to look for an order block. Okay.
Okay.
So an example of an expansion is here. So you see this movement to the upside that this is an impulsive movement to the upside that caused the break of structure here. Okay.
Mm-hmm.
So it means this expansion is the movement that we are going to actually try to look for an order block here. So in this area, we're going to look for an order block. Okay.
Okay.
So we need to see an imbalance. Also, we have to see that this market actually, this movement actually broke structure to the upside and left behind an imbalance, or what you call inefficiency or fair value gap. And then you're going to locate your order block. Okay.
Clear.
Yeah, so that's an expansion. So it's an area where you're going to look for an order block. This is where you're supposed to actually check an order block, and we can call highlight our order block here. Okay. So we mark our order
Mm-hmm.
block on where we have an expansion. And on a retracement, we actually expect to see price filling an imbalance. Okay.
Okay.
So price actually comes down to fill an imbalance, like what we see here, to fill an imbalance and to actually mitigate the order block before you can actually buy. Okay. So a retracement is always a movement that is intended to fill any imbalance in the market. Okay.
Mm-hmm.
So that's what you call it, retracement. So retracement is just movement that is filling some imbalances in the market and creating a balance in the market. Okay.
Okay.
Yeah, so that's the retracement, and the reversal is where we say we seek liquidity grab. Okay, so here we for example, in this structure here, we are buying somewhere here, we said to buy there. So what we do, we expect to see price moving to the upside. And where are you going to actually put your take profit? You're going to put your take profit to where you expect to see price, or what you can say, where you expect to see price breaking. Okay,
Mm-hmm.
like this is our previous high here, or our swing high. So this is our previous high, which is also one of the example of liquidity. If you remember, I said swing high or an old high is what we call a liquidity. So it's a liquidity. Okay.
Yeah. Yeah.
So if you're going to buy here and you know this market is bullish, so and in a bullish market structure, we know that price will always break previous high and create new highs. Okay.
Mm-hmm.
So if this is a new high which was formed, we expect the price to move from down here where we had an order block and until price breaks this level. Okay.
Mm-hmm.
So it means this is where we have liquidity.
Clear.
Okay. So and a reversal is always seeking liquidity. Like it's going to actually focus on where liquidity is and take that liquidity. Okay.
Mm-hmm.
That's it. So this is just a
Clear.
simple explanation about how price move. So this helps us to actually know, for example, if I'm actually, or you're actually explaining to someone, or you are trying to actually understand on your own, like this is a consolidation and this movement is an expansion. So it makes easy for you to actually try to determine the movement in the market. Like right now we have this expansion and I'm waiting for a retracement to fill the imbalance before we mitigate our order block, and then I can actually buy, expecting to see a reversal in the market. Okay.
Mm-hmm.
So this helps even in actually explaining what is happening in the market. Like you see prices creating a retracement, okay, a pullback, prices expanding to the upside. Okay, so it helps you to know these kind of movements. Okay,
Mm-hmm.
yeah. So that's all about these price cycles. No, there's no any complicated any complication. Okay, so we have an example you can see from these charts. Okay,
Yes.
like this was a
This consolidation here.
consolidation, expansion to the upside, leaving behind this kind of imbalance here. Okay,
Yeah.
so you expect the price to come down, retracement, and fill this imbalance here. Okay, and mitigate our order block here, this order block here, plus the blue candle here. Then you can buy from here, expecting to see the reversal. Okay, and this
Yeah.
And this point where we have this old high, this is going to be our buy side liquidity. Okay.
Mm-hmm.
We target there, we're going to put our take profit there. Another example, when we are actually expecting to sell, you can see from here,
Yeah.
price actually trying to consolidate. This consolidation is not something that you can actually observe all the time. Like, it's not a must for you to see a very clear consolidation all the time. Sometimes you may see price just trying to go up and down, and then you see a block of structure to the downside. Like what happened here, like price tried to go up and then tried to actually form like a kind of consolidation here and then broke to the downside. Okay.
Mm-hmm.
So this is an example of a consolidation here. So I have this consolidation, a small consolidation here, and then you see price breaking down, okay, creating this break of structure here, okay.
Mm-hmm.
And after break of structure, we try to observe this kind of any imbalance here. So you can see we have an imbalance there, okay. So we have an imbalance there. So this expansion left behind some imbalances, and you can see we have a lot of imbalances here, okay, like 2 imbalances. So we have some imbalances here. So what we do, we are going to mark where we have our order block, okay.
Clear.
So we mark our order block here, we extend it to the right. You wait for price to actually come and mitigate this zone. So this is what we call retracement.
Mm-hmm.
And you can see a nice reversal to the downside here.
Yeah.
So you can see, like, it's not always complicated when we are trying to analyze the market. Like, just wait for this kind of setups, like wait for change of character. If the market was bullish like here, wait for change of character, then you can actually start to look for opportunities. Like here, after change of character, we had a consolidation. So we wait until we see price breaking out of this consolidation before we can start to
Mm-hmm.
actually look for opportunities. Okay.
Sure.
So that was an example. So this is a small explanation about smart money concept. So I think I explained it in the beginning what a smart money concept is. Okay.
Yeah.
So this is going to actually help you to read more and see like, oh, so this is why we call it smart money concept. Okay.
Mm-hmm.
Yeah, so that's all about price cycle. Okay. Another simple thing
Clear.
to know is these things. They're very simple things to know, but they're very important to understand. Okay.
Uh-huh.
So we have this kind of aggressive entries, and we have what we call confirmation entries. So there are 2 types of entries, you know. It depends on actually how you are actually trading. So it depends with your way, with your system of trading. But to me, I like to use confirmation entries. Okay.
Mm-hmm.
So you'll see what it means. Okay. So aggressive entries, these are entries directly from the original point of interest. Okay. So this aggressive entry is that entry from the original point of interest. For example, we are actually analyzing maybe from 4-hour time frame. Okay.
Mm-hmm.
And we see nice bullish market structure. We wait for price to maybe break structure like that, wait for our order block here. So if it's 4-hour and price comes down into our order block here, we know it's a good opportunity for us to buy, is it?
Yes, of course.
But if you execute your trade in the same time frame, like you just opened your chart, you are in 4-hour and you analyzed and you saw good opportunity and price came into your order block and you want to execute your trade here. So this is what we call aggressive entry. Why? Because this is the original point of interest, the original point of us to actually buy. And we call it
Mm-hmm.
original because this is the first area that you saw price mitigating. So what you do, if you're going to execute here, this is called aggressive entry. But if you're going to actually go to lower time frame, maybe 30 minutes, okay?
Mm-hmm.
Yeah, you are not going to execute here. So you go and wait for maybe 30 minutes, wait for price to create some kind of change of character, okay? So you wait for price
Okay.
maybe to create some change of character like that, okay? And then come down into new order block. But remember, at the same time, we are in the 4-hour order block, okay? We are still in that zone
Mm-hmm.
where we had a mitigation on 4-hour. So the moment you wait for, like you went to lower time frame and you're waiting for another entry here at the same currency pair, but different time frame. So the moment you execute from here, it means this is going to be a confirmation entry
Okay.
because you are actually confirming a buy setup. from 4-hour time frame. 4-hour time frame gave us a very nice reaction, okay, and we saw price mitigating our order block on 4-hour. So what we did, we all, maybe you are not executing on 4-hour because you are not that kind of a trader. You are a trader who is actually executing on lower time frames. So what you do, you go to lower time frames and look for another buy opportunity. Okay, that's what you call confirmation
Clear.
entry.
Mm,
It is clear, is it?
clear, brother. But why we supposed to choose 4-hour time frame? Because it's take too much time, nah? So can we choose 1-hour time frame in the first confirmation? Then second confirmation, can we go with the 5 minutes, 10 minutes, 15 minutes? Is it okay for it, or we have to wait? We have to choose 4 hours time frame.
No, I think that's okay. Let me explain. About that is like this. Okay, so when you want to analyze the market, I will explain this, and I think I just want to finish this PDF, this ebook, and then after
Okay,
this
okay,
PDF, I will actually
okay,
be
okay.
teaching you depending on the live market and not again on this type
Sure,
of words. So
sure,
let
sure,
me,
sure.
yeah, so let me just explain it a little bit. Okay, so
Mm-hmm.
when you're talking about analysis, or what you call higher time frame, or what you can call multiple time frame analysis, okay, so we analyze on different time frames, not just a single time frame. Okay, so we
Mm-hmm.
analyze from higher time frame to medium time frame, then to lower time frame where we are actually executing trades. Okay,
Okay.
so if you want to be profitable in the forex market, this is what you're supposed to do. You're supposed to use multiple time frame analysis. You're supposed to analyze from the higher time frame to the medium time frame and then to the lower time frame. So you can have a three-step system of analysis. Okay, like you start from higher time
Mm-hmm.
frame, then medium time frame, then lower time frame. Like, so it depends with the time frame that you actually you like to execute, or depending on the kind of a person you are. You are maybe not someone who is patient enough to wait for market to give you, maybe to hit your take profit after 2 days. Maybe you just want to trade on a single day and actually get your money on the same day. Okay, so if you're that kind of
Mm-hmm.
trader, you need to actually trade the lower time frames. Okay, you need to execute maybe in 1 minute, 5 minutes, 15 minutes. Okay,
Mm-hmm.
but there are other traders who like to hold their trades maybe for 1 day or 2 days or 3 days and more. Okay,
Okay.
so for example, you like to execute on trades, or maybe you like to, maybe according to you, maybe you like to take trade on which time frame to execute your trades, whether to buy or sell.
Mm.
For example, you maybe what kind of time frame do you think is to you is actually okay? You can use it for buying and selling, like you can execute trades on that time frame.
Sure, sure.
So for example, I just want to ask you, okay,
Mm-hmm.
what time frame do you think you can use it as your entry time frame?
Normally 5 minutes time frame, brother.
5 minutes. Okay, is it
Yeah.
5 minutes? So if it is 5 minutes, it means your higher time frame, or that's lower time frame. Okay, that's lower time frame,
Okay.
5 minutes.
Mm-hmm.
So what is the medium time frame? 15 minutes. Okay,
Okay.
and what is your higher time frame? 30 minutes. Okay,
Uh-huh.
so you start from 30 minutes, then 15 minutes, then that's going to help you to actually know, like, it's going to give you more confirmation, like what you are actually expecting on 30 minutes is also going to happen on 5 minutes.
So,
Like
you're
if you
right.
saw if you saw a very nice buying opportunity on 30 minutes, means if you go to 15 minutes, you're going to check if it's okay. It in the we are going to do what we call refining our order block. You're going to refine your order block. So is it in a nice area? Can I see any kind of change of character? Okay, if you can see a change of
Mm-hmm.
character on 15 minutes, then you go to five minutes and look for your mitigation of the order block. Or it may happen like on 15 minutes there is no any change of character, so you go on 5 minutes, wait for a change of character on 5 minutes. Okay, if you see change of
Clear.
character on 5 minutes, then you are going to actually look for your order block, and then you can wait for price to mitigate that, and then you can buy. Okay,
Okay.
so it's not a must for like your higher time frame has to be 4 hours. It's not like that. But also there are some
Clear.
traders. who like to execute to analyze from a lot of time frames. Like someone is analyzing from maybe daily time frame or weekly time frame to then 4 hour, then 1 hour, then 30 minutes, then 45 minutes, then 15, then 5, then he has execute trade on 1 minute. But that is very complicated kind of analysis. It's going to confuse you if you use that. Okay.
Fine.
The important thing is to actually use your to know your the time frame that you are going to execute trades. Like I'm going to be a trader who is actually executing on 5 minutes. So what I'm supposed to do, I just need to focus on 2 or on 3 time frames. You can use 3 time frame or 4 time frames, but not more than 4. And if you use more than 4, that's going to be complicated. That's now it's going to confuse you. Just know, like,
Okay.
I'm a trader who executes trades on 15 minutes or 5 minutes. So I'm going to look on what is the higher time frame. What is the time frame that is before 15 minutes? What's the time frame? Maybe it's 30 minutes. Before 30 minutes, what was the time frame? Maybe 1 hour. So you're going to analyze from 1 hour to 30 minutes, then to 15 minutes. Okay. So it's not about, it is a must for you to trade from 4 hour, to analyze from 4 hour. No, it depends the time frame that you execute your trades.
Clear.
Yeah, and if you are someone who trade, maybe you execute your trade on 4 hour, it means you're supposed to do your analysis from monthly or weekly time frame. Weekly, then daily, then 4 hour. Okay.
Clear, brother.
Yeah, so that's an aggressive entry, the entry that you execute on the original point of interest. Like if it's a higher time frame, you always say from higher time frame. Okay. But it is not a must. Another thing to know, it's not a must for that aggressive entry to be a time frame, to be like a higher time frame. Okay.
Okay, brother.
It can be the same time frame. For example, you analyze from 4 hour, then 30 minutes, then 15 minutes. And you actually on 15 minutes, you saw a very nice buying opportunity. Okay. But maybe, for example, let's say you actually analyzed before it happened. Okay. You did your analysis before it happened, and you are waiting for the market to come into your order block. Your 15 minutes order block for you to buy. Okay. But what happens, because we are humans, sometimes we forget. Like you just forgot, and when you came and checked your charts, you actually saw like price is already moving to the upside. Okay.
Yeah.
So you missed this opportunity here. Okay.
Yep.
So what you do, you're not supposed to actually immediately to enter where the market is. Okay.
Okay.
Because that's going to be like a lot of stop loss first, and also you never know what will happen. So it's better don't just take trades when they have already left you behind. Okay.
Okay.
What you do, you're going to wait for a confirmation entry. You're going to wait for price to come down again, because maybe
Clear.
when it was moving to the upside, it created a change of character like that. So it
Maybe.
mitigated your order block, and then it's a must for us to see a change of character before we can actually say this is another opportunity for me to trade, because it is a must to see break of structure, either break of structure in the same direction or in the opposite direction. Like here, it is a break of structure in the opposite direction. We are moving to the downside, and price is starting to move to the upside. So this is change of character. So you wait for change of character, mark your order block, look for an imbalance, and then wait for price to come down again here. So aggressive entry is just it can be on the same time frame that you are also going to execute. Okay.
Clear.
Yeah. So it happens when you miss your entry. So it means the aggressive entry now is this the time frame that you missed your entry. That is your aggressive entry. And the time frame that the moment you are going to wait for another mitigation on the same time frame, that's going to be your confirmation entry. Okay.
Yeah, most of the time it will be retraced with first and second time also.
Yeah, but don't yeah, it depends on how it is creating that mitigation. So if it creates some equal lows, now you need to be careful. Don't wait for the third touch.
Yeah, right.
Take you out of the market. So the first and the second can happen, but the third is always very dangerous. Okay.
Yeah.
Yeah, so you have these benefits just for that to actually help you to know how can we actually, what's the important of these aggressive entries. You may ask yourself, why are some people trading aggressive entries and why some people trade confirmation entry? So the aggressive entries is good because, for example, you are in higher time frame, like let's take an example, it's 30 minutes, okay?
Mm-hmm.
And you saw price mitigating your order block, like price was moving to the upside and price came down into your order block, 30 minutes. So what you do, if this is your first touch, this is your now what you call aggressive entry, is it?
Yeah.
What you do, if you are using aggressive entry as your type of entry that you execute trades, now if you execute here, it means it eliminates the chance of being left by a potential setup. Why? Because if you execute here, it means you're already executing after you have saw price mitigating your order block. But if you start waiting for a confirmation entry, sometime you may miss your opportunity. Okay.
Clear.
Because not all the time the market is going to create another confirmation entry. Sometimes the market touches here and it moves to the upside very fast, and there is no any room for you to wait for a confirmation.
Yeah.
So
You're
it
right.
means, yeah, so it means for those people who trade these kind of entries, the aggressive entry type, they eliminate that chance of being left behind by potential setup. Is different from traders who use confirmation entries, because sometimes the market is not even going to create that confirmation.
Mm.
Another thing is that it helps you to set a limit and have a continuous monitoring of the market. So this is just normal, like it's going to help you like to know if I'm going to put my stop loss here, okay, and it's going to be easy for you to monitor the market because you're just going to execute here and you're going to look on what is happening here, okay.
Fine.
Different from someone who is actually trying to wait for a confirmation, okay.
Mm-hmm.
Yeah, so the drawbacks or the challenges, like we have low risk to reward ratio because your stop loss will usually be bigger due to entering higher time frame. This is understood, is it?
Yeah.
So if you
Yes,
execute on
yes.
30 minutes, it means you have more pips, different from what we actually have in confirmation entries or lower time frames. Okay.
Yeah.
It's the same as what I explained. Like if you found the market is already moving on a direction and you missed that opportunity, you missed that aggressive entry, it means you cannot just trade from there because it's going to cover a lot of stop. Your stop loss is going to have a lot of pips. So what you do, you just
Yeah,
wait
it
for
will be big.
confirmation entries. Wait for a confirmation
Yes.
entry so that you may have small or small stop loss, and then you will have a few pips. Okay.
Clear.
So a confirmation entry is just like execution on the lower time frames. Okay.
Mm-hmm.
Yeah, once price mitigated either your order block or any point of interest. So you wait for a confirmation. Like you already had a mitigation or what you call retracement. Price just retraced into the higher time frame order block. And what you do, you go to lower time frame. Try to wait for You need to wait for a change of character on lower time frame, and then look for an imbalance on that expansion that caused what you call change of character. Then you can draw your order block and then you can wait for a confirmation. So I think you know about the confirmation entry, is it?
Yes, brother.
Yeah.
Clear.
So higher risk to reward ratio, that's the benefit. Okay. So it means you're going to have a small a very small stop loss, and then you have few pips. It means you're going to lose a small amount of money. And if the market hit your take profits, means you're going to have a lot of money. Okay.
Mm-hmm.
So just using a small lot size, which means a small not lot size, small stop loss, which means you are risking a small amount of money. Okay.
Yeah.
That means it's good for you. If you can risk small amount of money, it means that is good, whether you get a profit or loss. But if it is a small stop loss, it means also you're going to lose a small amount of money. That's good for you as an investor or a trader. Okay.
Yeah. Yeah.
So
Right.
that's one of the benefits. Okay.
Mm-hmm.
Another thing is that it gives us extra confirmation. Like the trade is likely to go in your desired direction. Like you saw on higher time frame price mitigated the bullish order block. So you expect to see an uptrend, okay, movement to the upside, okay. But if
Okay.
you go on lower time frame and you mark again another, and you refine your order block, and then you look for a confirmation entry, it means you are getting more and more confirmation. So you become more confident when you execute your trades.
Fine, fine.
Yeah, so that's it. And we have these drawbacks here. So it's not a must like the market will present a confirmation. It's not a must like the market is sometimes is not going. The market does not care about you. Okay.
Mm-hmm.
Sometimes it's just move in the direction without giving you any confirmation entry. So it means for those who executed on an aggressive entry, they are inside they are already running in profits. And someone who is waiting for a confirmation is out of the market because there is no any confirmation. So that can
Clear.
happen. Okay, it's not going to happen all the time, but it can happen. Like the market is not going to actually mitigate your confirmation entry. It happens sometimes.
Mm-hmm.
So that another kind of drawback. So everything has some drawbacks, everything has some challenges, but you need to actually know what kind of entry is safe for you, is good for you. Okay.
Okay.
Yeah, so this is going. Yeah, another thing is that you're going to spend a lot of time trying to wait for a confirmation, trying to identify a confirmation entry. Okay.
Mm-hmm.
So look at this chart here. You can see we had this very big order block here, covering I can say a lot of pips because it's very big. Okay. So from here
Yeah.
up to here, this was just an order block. So if you're going to enter here, it means you're going to actually put your stop loss here. That's a lot of pips. Okay.
Yeah.
So what we did here, you can see after mitigation here, price wait for what we call shift in market structure or change of character. Okay.
Mm-hmm.
And after change of character, you mark your order block, and you can see here we had an imbalance. Price caused that
Mm-hmm.
change of character, left behind this imbalance. So we mark our order block here. That's why we wait for this confirmation entry. So if you enter here, you're going to put your stop loss here. It means that small amount of pips now. Okay.
Yes. Yeah.
Yeah, because we always put our stop loss a little bit above our order block. Okay. So
Okay.
in our current order block was this. So we just put it here. So it means we have a small amount of pips. Okay.
Mm-hmm.
So if we just focus on our take profit, we can either put it there or here. Okay. So these levels you see, they are lower levels. So you can choose any depending on how you are, like the way you feel confident. But this is what we call a confirmation entry. So you can just put your take profit even here or down here. Okay.
Fine, brother.
Yeah. So that's an example. And another example is this one. You can see here. So this is risky. I labeled this one risky because there is no any clear change of character here. If you look careful here, price just went to
Mm-hmm.
the upside, didn't even take this previous high, okay,
Yeah.
and just came down here. So this is very risky. You cannot say I'm going to buy here, okay.
Yeah.
So this is risk. So we had to wait for this kind of thing here to happen, change of character or shift in market structure, okay.
Mm-hmm.
After that, you can actually look for imbalances, okay.
Yes.
So we see an imbalance, price came down, and actually we can use this. It depends on how the market is, and depending on the way you actually analyze the market. Okay. In
Mm-hmm.
labeling, oh my god, where is it? Okay, here. So when we are
Yeah.
actually
That's
trying to mark our order block, okay, as
mm-hmm.
as you continue practicing, this is a reality about trading. As you continue practicing, the way you are going to mark your order blocks is going to even be different from how I can actually teach you. Okay.
Okay.
Because you're going to get your own experience and you're going to actually think like, to me, I'm going to mark like this is going to be my order block and this is not going to be my order block. For example, here we had this. You see this one? This was an order block.
Yeah, there's also.
And you can see price mitigated it here.
Yeah,
And we had
exactly.
this very nice movement to the upside. Okay. So if you
Yep.
entered here and you put your stop loss on this previous high there, on this previous high, it means your take profit was hit here. So you are already in profit.
Yeah.
But also imagine
Yes.
somebody missed this one and price went up. Okay. Creating another block of structure here. So if you're going to mark your, if you're going to actually mark your order block, you cannot mark this one as your order block here. This one. Okay.
Okay.
This is because there is no any clean market structure here. You see, the market is just trying to, like, we had this kind of trend line there. The market is just creating the market, the way it is moving, it is forming this kind of trend line. So if you're going to execute, you cannot just draw your order block here because this region is an area where we had a trend line, like another example of liquidity. Okay.
Yeah.
So what you do, you just think like this area here is going to be a liquidity zone. So from here up to here, this is, so you can expect to see price taking this. So what you do, you wait for liquidity to happen. That's why I labeled this area here, because these charts, I actually analyzed them before this thing happened. So I used this one. Okay. I used this as an order block because I already knew like we had a mitigation here. And after mitigation,
Yep.
price actually created this kind of trend line. So I know like this is going to be very risky area for me to look for an order block here. So what I do, because I know this is an area where there is liquidity, so I expect the price to take it. So once price take it, it means I just need to know where can I expect to see an area where I can see price bouncing and continuing to the upside. Okay. That's why I used this one, because this one is going to actually be a good area. Why? Because we even had this risk entry here. Okay.
Clear.
Like price came down and mitigated this, and then we had this. So this was a new point where I can actually use it at the point that price will come and actually respect this. Okay. That's why we
Clear,
had this.
clear.
So this can actually happen depending on the way you actually continue practicing. So we have less than 1 minute. I think anytime the meeting is going to end. Okay.
Sure, sure.
So you can see another example: aggressive entry, confirmation entry. Okay.
Yeah.
You miss this opportunity, you enter here. So this can happen when you miss an entry. Okay. You miss this movement, you miss this movement. So you're going to wait for price to come down here. And then to come this area, not down, to come this area, and then you can actually